Welcome to the Dividend Talk podcast, episode 48, Growth Investing with the Wolf of Hardcourt Street. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DJI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to this channel, please hit the like button and subscribe to us, and check out our previous episodes on YouTube and Spotify. See you on the inside. Hey European DJI, how you been this week?
Like always, busy. I think that's my standard answer.
Yeah.
How about you?
Same. I'm only in from work to record this. We've got a guest on. We've got the Wolf of Hardcourt Street. How are you doing, buddy?
Thanks for having me on, guys. No, I'm doing well. Really looking forward to being on the show. I'm a long time listener, so it's great to be part of it and contributing today, hopefully.
Yeah, I know we all kind of conversed on Twitter a little bit, so we know a little bit about each other. But if you'd just like to introduce yourself briefly to our listeners so they get a picture of who you are.
Yeah, so the accent might give it away, but I'm an Irish investor. I'm 28 years old, so just on the right side of 30, just about. And my background is accounting and finance by day. So I'm an accountant in the financial services industry. And I suppose by night or at weekend, I'm passionate about investing, both growth investing and value investing. And outside of that, yeah, I'm big into sport as well. So GA, our local games here in Ireland, for those of you listening.
Nice. We'll get into some of the investing later on. We might just have a little chat about some of the news of the week first, and we'll ask you some questions if that's okay.
Sure.
So European DJI, what's been happening in the world this week?
Wow, a lot. But for me, what really, of course, was the big news item for this week was inflation. So it had quite, I think, some pressure on the market as well when the inflation numbers came in. And it was funny, right? Because we spoke about this before, and it was so obvious for me when I was reading the quarterly reports and the statements where every company like Coca-Cola, Kimberly-Clark, all of them were reporting that there's high commodity prices, inflation, and such. So I'm still surprised sometimes how it catches the market by surprise. But for me, it was nice because it gave me a nice opportunity to, to start looking at some companies again, to add a little bit up because, for a dividend growth investor, it always feels expensive. So it's always nice then to see a little dip. So yeah, definitely inflation was, I think, the narrative of the week for me. How about you guys?
Yeah, I've seen inflation a lot. And the one chance I got to tweet, I put out something about inflation. It just seems to be everywhere at the moment. But I've also seen you put a good tweet out, or someone had a chart of inflation, and you just said zoom out. And if you zoom out, it was literally at pre-COVID levels. So it seems like it's been a buzzword thrown around and getting a little bit out of hand. But it's definitely been flaunted around quite a bit this week.
Yeah, so that picture that you're referring to was the 10-year treasury yield, which is now around 1.7%. Yeah, so I'm not surprised at all. I mean, I think it will only be more. Imagine the world start opening up, summers are starting, people are getting vaccinated in most of the places. I think there will come in some areas there will be really a shortage of things. And just think about restaurants, all those people that lost their jobs. Now restaurant owners would need to hire people again. But imagine you were, I don't know, a cook or a bartender. What would you say? I think I would have tried to reskill myself over the last 1.5 years to find a different job. So I think we will see a lot of salary inflation in those areas as well. So, and that all has to be passed on to the consumer, I think.
Yeah, Oh, certainly. So the news item that I have, it's not really news, but long-term listeners will know that we both like Ahold Delhaize, and they reported some earnings this week, which were quite positive and quite strong. I know the share price rose a little bit and has come back down a small bit, but it's encouraging to see how good they are. I still think they're grossly undervalued, and probably one company that I will be stocking up on quite a bit on them. What did you think of their earnings overall? Were you happy?
Well, the earnings were as expected for me. Actually, you could even argue if you really go through the accounting numbers, let's say they were probably even little bit on the lower end. If I remember correctly, I think a bit again around working capital and such. But what really caught the attention of the market was their increased guidance. Yeah, and remember after how you said, after the full year numbers, they had 2019 guidance effectively with 1.6 billion such.
Yeah.
And now there was of one of the four items they had an increased guidance, and this really triggered the market to I said adjust again back to the numbers from 3 months ago. So, and I think that's the bump that we saw, and it just confirms my thesis and what we discussed about as well. EMF when we talked a lot about Ahold, is like this CEO and specifically I think even the CFO, the lady there, they have this UPOT method of communication, right? Under promise, over deliver. So they're all the time under promising, really conservative. And that's what I'm noticing with this company. And that's maybe also why I like it so much, because it's a bit anti-pattern to other companies.
Yeah. And I seen their dividend guidance for the year, which is a 40 to 50% increase in dividend per share, which is good for us as income investors. So no, it's a company I'm really excited about, and I really think there's some value there. I seriously think they're underpriced, so I'm looking forward to adding more shares and seeing how they go for the rest of the year. How about you, Wolf of Harcourt Street? Have you anything in the news you saw?
So I suppose I'm not into crypto, but I did notice that Mr. Musk was busy tweeting. I think it was on Wednesday. He put up a tweet and said that Tesla were going to suspend accepting Bitcoin as a payment for vehicles, and he kind of said that it's to do with the environmental impact of mining Bitcoins. And I thought it was a bit ironic that he came out and said this. Like, it's not really new news that Bitcoin absolutely drains resources. So I thought it was, where is he kind of going with this? And it didn't really take long, because I think today, a day later anyway, he came out and put up another tweet and said that Tesla are looking into accepting Dogecoin. Or working with the developers of Dogecoin to make it possible to pay for vehicles with, I believe, a cryptocurrency that was originally set up as a joke. So maybe the joke is on the people who haven't been buying it, like myself.
I mean, it's quite obvious what he's doing, isn't it? He's manipulating that market that's so easy to manipulate at the moment. And he got into Bitcoin, made a crap load of money out of Bitcoin, and now he's going to push the price down of Bitcoin and inflate Dogecoin. I mean, it's just incredible how he's able to do this. Imagine having that power.
Yeah, that's the thing. Like, for me, it's like the power that one individual seems to have over cryptocurrency and Bitcoin, Dogecoin. Like, it really is like really hard to comprehend. I think, like,
I just wish he'd push AT&T. Maybe their price might double overnight.
To the moon.
I really think he will get into trouble with this. I don't think that Securities Exchange Commission will let him easily get away with this. I think they will be on him, because they have Bitcoin on the balance sheet. Don't forget that.
Yeah.
So I cannot imagine that someone ringed them up already, like, okay, and now he went too far.
I mean, he's making it blatantly obvious. He couldn't be any more obvious in what he's trying to do. And he got into trouble with the SEC before, hasn't he, on something like this?
Yeah.
I think so, yeah.
He has a track record, but I mean, he probably just has so much money, he'll just pay them off. He'll get a slap on the wrist.
Yeah, with his profits from Dogecoin.
Yeah. Brilliant. Okay, so what we might do now is we might do our rapid fire questions. I have a couple here, so I might begin. Don't worry, Wolf. These are not too hard. So I'll go first. Blah or BAP?
Ooh, I'd have to go blah. Has to be
Football or soccer?
football.
Ooh. Guinness off the shelf or from the cooler?
From the cooler.
Okay.
Okay, so I've got also two for you. Savings rate or tax rate?
Savings rate.
Then the last one, China or America?
America?
Cool. Is there anything you would like to provide some further clarification on?
I thought the savings rate versus tax rate was a good one. And why I went with savings rate is because generally you can't control your tax rate, but you can control your savings rate. So I think, as the saying goes, control the controllables. Obviously you could move tax jurisdiction, but you can control your savings rate more than your tax rate.
Yeah. And as you're an accountant, I don't know if you're also a legal advisor, but we should have someone once on the show that can tell us like how to avoid, no, not how to avoid tax.
Minimize.
What is it?
Minimize
tax. Yeah. Like could we do that with dividend taxes and then what is it? Via Netherlands and Ireland.
Double taxation agreement, yeah.
Yeah.
a bit like Google. Can we just do what Google does?
Yeah, exactly. If they can do it, why can't we do it?
Exactly.
Okay, awesome. So we might then move on to our main topic, and we're just going to talk a little bit about your investment strategy. It's nice to have someone else from Ireland here. I know we have slightly different strategies, so it's good to get different perspectives. So if you just like to start and describe your investment strategy to us.
Yeah. So first off, in the grand scheme of things, I would call myself an inexperienced investor. I've been investing just over a year. And at the moment, I invest in a mix of growth and value stocks. And I'm predominantly weighted to growth stocks. I'm a long-term investor. I don't trade. I don't speculate, or at least I don't think I speculate. I just invest for the long term, using a flexible dollar cost average approach. In terms of my goals, I suppose, like why am I investing? Financial freedom is obviously the end goal within the next, I suppose, 15 to 20 years. And as well as that, learning is an important part of my investing strategy. I like to learn new things as I'm going along. I'm always looking to, better myself as an investor. So I think that's also a goal within my strategy, is to, become a better investor as I go along.
Does the Irish pension scheme come into your strategy somewhere?
Yeah, so I'm working as a PAYE employee here in Ireland. So, I'm working for a multinational. So I do have a pension, but I'm only essentially putting in the minimum amount. My employer contributes percentage, and then I contribute as well on top of that. So I do utilize my pension, but I don't put all of my eggs in a pension, probably for a couple of reasons. The first one being, it's not really accessible until you retire. So, that could be in your 60s. And in my case, that's quite a number of years away. So I prefer having an investment portfolio as well as a pension. So I kind of view the pension as a bonus. It's there, but I'm not actually relying on that. I'm really working myself with my own investment portfolio. So I do have a pension, but I don't rely on it fully.
Yeah, pensions in Ireland are strange. It's probably the only tax efficient way we have to invest, but they are complicated, really complicated for the common investor to understand what's actually happening, and they're constantly changing the rules, which is why I don't like you say, control the controllables, and you have no control over this. I know they're trying to change the structure now to a more pan-European structure, similar to what they have in Europe at the moment. So everything is kind of up in the air. But I'm like that as well. I don't really like to have all my eggs in that. It's a question I'm always asked: do you max out your pension and pension this? But for me, you still pay tax at the end.
Yeah.
I mean, it's tax. I know it compounds quicker now because you don't pay the tax, but you do pay tax on it eventually at some point. And like that, I use what my employer puts in, and that's as far as I go. But I believe you did start, and if I remember, you did start as a dividend investor or dividend growth investor. So what changed your mind? What was the 360 on that?
Yeah, exactly. So when I initially started, I had a nearly 50-50 split between growth and dividend growth stocks. So dividend growth stocks, like there's a lot to like. I'm on a dividend podcast, like there's a lot to like about dividend stocks. I think it's really satisfying seeing dividends hit your brokerage account. It's tangible. You can see those dividends rolling in, and it's really easy to see them then building up and, as you say, compounding over the long term. My change was purely tax based, and it's pretty much that was really what drove me in Ireland. So this is, what I'm saying here now is going to be very specific just to Irish listeners. But for some context, we've got, income tax on dividends, and then you have capital gains tax on, gains on a sale of a share. So in Ireland, you file your tax returns once a year. So for dividends, you declare these on top of your income or your salary or whatever, and these are taxed at the marginal rate in Ireland. So for me, that is 52%, which is very high. So any dividend I receive, I could receive €10 in dividends. 52% of that is gone immediately. So there's no allowance on that. 52% straight off is gone to the tax man. If you compare that then with capital gains tax, the rate is 33%, but you also have an annual exemption, which I believe is €1,270. So you could make gains on the sale of shares. You could make a gain of €1,270 each calendar year, and you won't pay any tax. But you could make then, as I said earlier, you could make gains on dividends of €100, €500, and 52% of that, in my case, is automatically gone. So, I was weighing it up, probably January, February time, after kind of, looking at my taxes for the year, because that calendar, like 2020 was my first official calendar year of having to declare income tax and extra income tax and investing related taxes, shall we call it. So what I kind of decided then was that it was just too high in my case. I didn't need the extra income either in my circumstance. So the extra income wasn't going anywhere except back into my investment portfolio. So 52% I was losing it, and it was essentially going back in to my portfolio. So I decided that I would switch from that element of my portfolio that was dividend growth. I would move it to just purely value stocks. So it wasn't going fully growth, but more geared towards value stocks. So I didn't actually end up selling a lot of stocks. So far, I've sold only 3 from my original portfolio. They would be Realty Income, Hasbro, and Walmart. So I haven't sold every dividend stock. So I think the important thing to kind of differentiate with me is when I say I'm no longer investing for dividends versus value, a company could still pay a dividend, but what I'm looking at in that company is the return that I believe going to be predominantly from capital appreciation, or is it just paying out a dividend? So, let's take the example of Realty Income. Now, my opinion is that that's just a really, really steady dividend payer. You're going to get your dividend every month. Do I see a lot of capital appreciation there? Probably not. And I don't think that they're not trying to do that, because they have to pay out 90% because it's a REIT. Whereas if you take the example of a Microsoft or an ABBV, which I have both of those. Microsoft is Microsoft. Just a lot to like there. It pays a dividend, but it's got so much potential in terms of capital appreciation and ABV as well. Even though the dividend yield is quite high, I actually think it's probably still a bit undervalued. So I think there's plenty of capital appreciation there ahead for ABV as well. So it's not just a rule of getting rid of dividend payers. It's really focusing on where is the return in the future from this stock going to come from. And if it's not from capital appreciation, it just doesn't really fit with my current strategy.
So I have actually still a question also about what we spoke earlier about retirement, because from that point of view, right? How do you envision yourself living off your investments? Is it the 4% rule or something else that you're aiming for?
Yeah, so this isn't something I've thought about in real detail, because I suppose I'm really, really far out from the end goal. But what I would imagine myself is actually eventually moving back towards dividend payers when I actually moved towards retirement, or maybe working part-time or something like that. My income tax rate will fall from the 52%. So when I fall back around to I think the other marginal rate is probably between 25-30, something like that.
26.
There's going to be more scope then for me to have additional income from dividends, and it'll make financial sense for me in my circumstances to again then move back towards dividends. So my strategy at the moment is my strategy at the moment. In 15 years time, when I'm trying to move towards working less, it will again evolve. So I think my strategy is something that's probably growing all the time, like my portfolio.
So it's kind of get as quick as possible, let's say, to €1 million, and then put it into income generating assets.
Exactly. That's what I'm focused on at the moment, is really accumulating wealth. Not necessarily building cash flows, which is probably the concept behind dividend growth investing. I'm really just trying to accumulate wealth at this point, and then once I have the wealth built up in 15 years or so, be able then to distribute that and maybe move it then towards some more income generating sources.
If you were still on the lower tax bracket, that your marginal rate was 20%, would you gear more towards what you're doing now or back towards dividends?
I would have more dividend stocks. Yeah.
Okay.
Yeah, definitely.
So it's a question I get quite a lot from Irish listeners, and I had a great conversation this week with a guy called Ben, and dividends at 52% is quite high. And if I was on the higher level rate like that, I would struggle as well, because it's a lot of money to pay. 52%, I mean, 520 for every €10 that you make. It is quite hard. My personal circumstances, I'm married, kids, and all that. My tax rates are different, and I'm luckily still in the lower rate, so it's okay for me at the moment. So I can completely understand why you've done it, but again, I see investing as a psychological thing, and as European DJI mentioned, how do you realize that money? And it's something that I would struggle with. And it's nice, like that you said that you will transition that over, but do you have a defined period of when you'll do that? Is that coming up to retirement, or will it be before?
Yeah, so it would really be kind of coming up to retirement. Like, I don't think you could just decide overnight, right, lads, I'm just going to liquidate half the portfolio here and transfer it. I think you really you'd have to take it piece by piece. So, you'd have to be utilizing your annual exemptions maybe for a couple of years in advance by selling out of your...
Because you have to pay 33% of any gains, so it'd be hard to transition that over.
Yeah, exactly. It's not something that you do overnight, from my opinion anyway, just with the taxes involved. I think, you probably have to start doing it from maybe 5 years out, I think.
Or you just start living... You just start living 1 year in a low tax country. Yeah, just go to one of the lower tax countries. You give up your wealth there. You liquidate your whole portfolio, let's say at 10-15% interest rate. The money you save with that can pay you probably then at that time the whole year living there in a nice sunny destination. I would be really using geo arbitrage in that situation.
We don't know what sun is over here. That sounds amazing.
I burn badly.
Yeah, but it is like that in Europe, right? You pay tax there where you're spending more than 200 days a year. So from that point of view, you could go to a different country with a low tax rate, for instance, where you hardly pay capital gains tax. Go there, make sure you live there more than 200 days, that you need to pay tax there locally. You liquidate your portfolio and you pour it into income generating assets.
I think with that though, it wouldn't just be one calendar year. You'd have to be tax residents. So
yeah, exactly. But that's one. I've been in that situation.
Okay.
Yeah. So just make sure you are, because European law says, and I don't know if it's 180 or 200 days, but you need to pay tax where your social status is for the majority, let's say for more than half of the year, so 200 days. And if you cannot say that from a work point of view or living point of view, they will look at where your family or your family or friends live. But if you go there somewhere and you just take a job there, then that's where you need to declare taxes and pay your taxes.
There you go. That could be an option.
Exactly.
Yeah. My former boss used to do that. He used to travel quite a bit, and he stayed in Ireland for just under enough time, so we'd pay tax where it was cheaper. It was quite clever. Quite clever. So what has your biggest learning been as an investor so far?
Yeah, so I think one of my biggest ones is that you can't borrow conviction in a stock. And I think this is definitely, it's applicable to all investments, but I think definitely to growth stocks. You know, you could be on Twitter scrolling through a timeline, you're seeing guys posting, you know, outrageous returns. And then you feel, oh, this stock, it can only go up by the looks of it. And, you know, you kind of jump on a trail, you jump on a hype train, and then what happens, like what's happening at the moment, there's a big drawdown in growth stocks and tech stocks. You're down maybe 20, 30, 40%. And then you're thinking, right, what do I do? Because you've just followed somebody blindly. Whereas if you've done your due diligence, you've done all your research, you know why you've invested in a stock. When the drawdown comes, you know, you've kind of got the time in the bank, and you know, okay, this is just, I've got to weather this. I still believe in the stock. I know why I've invested in the stock. The only thing that's changed is the share price. So I've got nothing to worry about. So I think that's a really important learning, that you just can't borrow conviction, especially in growth stocks.
Yeah, it's probably a trait that most inexperienced investors will have, particularly in the social media environment where everybody seems to follow the hype. Over time, as you become more comfortable, I know I started my journey following the dividend growth investor, and eventually outgrew that because I started to learn my journey. But I agree with you. I had companies in my portfolio, and I've said this on the show, and I had no idea why. Like Waco was one of them. I recently sold them. Why did I have Waco? Because somebody else bought them. So no, it's a good learning. It's okay to follow someone, but you are 100% right. You need to know the reason why you're investing in a company. But I suppose for you, we invest mainly in dividend companies that are mature companies. They have long histories, financial statements going back 10 years. They're generating cash flow, they're generating revenue. Growth stocks are typically not mature companies. They're typically in the early stages. They might not be generating cash flow. They may not even be posting a profit. So how do you do your due diligence on those types of companies?
Yeah, so I like to start off with when I'm trying to generate a stock idea. So even before I've even looked at an individual stock, I like to focus on trends. So I believe that, like, you know, the trend is your friend when it comes to growth stocks. Now, not the trend is in the share price. The trend and the underlying, you know, market conditions, or, you know, secular trends. So if you were to go through my portfolio, you could probably group a lot of stocks by a trend. So one of the first trends that I invested in was what I'd call the war on cash. So digital payments, essentially. So how this kind of trend, like lots of people believe in it, or it's kind of widely recognized that cash payments are sort of disappearing. And I remember last March when lockdown hit, all back into lockdown, working from home, weren't really leaving the house, they're supposed to. And I remember 3 months later, in June, I looked into my wallet, and I had the same crumpled up €5 note in the wallet 3 months later. And I can tell you that my bank account was not the same. So there was money leaving my bank account. So that was a clear trend for me, digital payments. So once I kind of had that trend framed in my head, next is actually looking at the trend. So looking at research to support the trend. So like there's lots of really, really good information available online. So what I'd kind of start looking at then is this a trend now, or is this a fad? And I think that's really important when it comes to growth stocks. Like there's lots and lots of fads, but a trend, is a clear path for the future. So like looking at, for an example, digital payments, Forbes had a good study saying that in 2021, 31% of the population would be Gen Z. So this means that, a third of the population are essentially tech savvy, or are going to be exposed, to digital demands, and are going to favor digital payments over cash. And, as you layered on top of that, COVID, for me, digital payments was a clear trend. So, right, I've got my trend. Now I'm looking for stocks within that. So once you kind of brainstorm a couple of stocks. So some of them that I eventually invested in that trend were Square and PayPal. So I kind of have then what I call like a due diligence checklist, and I've kind of shared this as a newsletter. So it's kind of just like a list of headings that you need to tick off when I'm analyzing a stock. So the first one would be, I suppose, just a general overview. Can I understand this company? You need to be able to generally understand what the company's doing and how it makes money. The next one, then, part of that would be customers. So who is using this company? Am I a customer of the company? If I am, what do I think of the company? If I'm not a customer, then there's reviews online, there's YouTube videos, there's lots of things where you can get a sense of the customer experience. I think that's really important. It's probably a bit underrated. Like, is this stock, is this product, is this service actually well received? So the next thing then would be, I suppose, your income statement, and predominantly revenue and margins. So with a growth stock, we want to see the revenue growing, and we also want to see the margins expanding, or at least being maintained as high. So if you need growth when you're investing in a growth stock, there needs to be growth, otherwise it's not a growth stock. Next, then I'd be moving on to the balance sheet and cash flow statement. So how much debt have they got? Have they got goodwill? If they do, what's causing the goodwill? Have they got investments in other companies? Your debt ratio, stuff like that. And then your cash flow statement, are they cash flow positive? If not, what's the path to future positive cash flow? Next, then, as well, valuation multiples. So for growth stocks, the PE ratio isn't always the most useful valuation metric, because, simply put, a lot of the stocks aren't actually turning a profit yet. So you'd be looking at other ratios like the price to sales, price to book, and really comparing the valuation multiples to competitors to see how your actual stock is comparing versus its competitors, and is it overpriced, underpriced? How has it trended over the last maybe year or two? Next, I'd move on then to competitors. So this is an important one. Often you could be doing research on a stock, and you could be doing research on their competitors, and you could actually realize that, whoa, I'm probably looking at the wrong stock here. Maybe I need to look at the X, Y, or Z competitor, because they seem to be doing it better. They've got a bigger market share. So you need to understand the competitors. Another important aspect I like to look at is management. growth stocks, there's a vision somewhere. It was originally an idea in somebody's head. So what I like to see is founder-led management. So, Mark Zuckerberg, a great example. I invest in Facebook. He is the founder, and his stamp is all over that company. So, like, if he were to leave, I think it would be a blow to the company. Now, it wouldn't be the end of the world, but you can clearly see that he has a vision with the company. And the final two items then are, I suppose, opposite sides of the coin. You've got your risks on one side and your opportunities. So you really have to know with growth stocks, any stocks really, what is the worst case scenario here, or what could happen that means that my thesis is in trouble. So I think this is really important when you're monitoring your growth stocks or stocks in general moving forward. If some of the risks that you have identified start to bear fruition down the line, that might then suggest that maybe you should get out of a growth stock. So I think you need to nail down the risks before you invest, so that you know what to look out for down the line. And then if something bad happens that you think is a bad impact, you have flagged it. Whereas if you might have considered something, I don't think that's necessarily a risk if it happens. And then if it does happen, you're not too concerned about it. And obviously opportunities, this is where you're seeing the company in maybe 5, 10, 15 years. What can it do in the future? Has it got extra products, services in the pipeline? Is it expanding into other niche markets? Have they, taken over any companies recently? So I suppose that's probably not so quite a brief overview of how I'd probably go about analyzing a company from pretty much the idea generation and right down to, analyzing it from the numbers and that.
Well, what I'm just happy to hear with is that there's a lot of due diligence, and it's funny because I guess how you said, what I'm coming more and more to the conclusion that if you really do due diligence, we usually look actually at the same thing, because I as a dividend growth investor, okay, and maybe in some cases I might not look so much at certain metrics as you look at, but I look at the products of the company. Is this a product that I would like to have myself or use myself? We look at management. We look at most of the same things, and this, I think, just value investing. Yeah, in the end, or what we learn in value investing. There are probably just some other components sometimes where one puts a little bit more emphasis on than the other, but also risk management is important here, like almost a post-mortem strategy analysis. And it's really interesting.
Yeah, like, for me, like, I don't like to say that I'm, a growth investor or a value investor. I like to just say I'm an investor. If there's a company that I like, if I think it's going to be bigger, better in the future, I try not to kind of, shoehorn myself into one category or another. I don't like to dismiss any investment idea just purely because, it's in this bucket or, it's in another bucket. And I suppose that's probably seen throughout my portfolio. Like, I've got your Johnson & Johnson's, you guys have covered this stock in a lot of detail and lots of episodes, and like, it's just a brilliant company. It's not a growth stock, but it's just a brilliant company. It's well managed, really diversified, just a great company. And I like having that in my portfolio just as much as, a C Limited or, a Neo or a Facebook. There's definitely a place, I think, for both.
Yeah, and I found it also interesting that you said that you don't really look at the price to earnings ratio, because I think EMF and I also don't really look at it from that point of view, because the earnings are so often manipulated that the multiple with the price doesn't say a lot. I mean, I put a one pager on Broadcom up today, which has a PE of 46. But why? Because they had large write-offs, right, from the past acquisitions, so it suppresses the earnings. So if you would then take a screener and you would use PE as one of your elementary, saying like, not more than 20, you would miss out on this stock because of a one-off write-off, let's say. So yeah, it's for me more and more just about cash flow, because cash flow and EBITDA, those are the two ones that are quite reliable from that point of view. You can't really fake accounting there, right?
No, you can't fake cash.
Yeah,
That's one of
exactly.
the things you can't fake. Or if you do, it's pretty illegal.
I think Wirecard tried to do
I
it
was just
recently.
about to say it, yeah.
And maybe then also a little bit for us and for the audience, what would you wish that dividend investors should understand maybe a bit better? Because you've been now, let's say, shifting your mind, I guess, a little bit in strategy.
Yeah.
What is it that you have learned that you wish we would understand better or take more opportunity from?
Yeah, I think the biggest thing that I probably see the difference between somebody who kind of dabbles in both value and growth. Value investors can often get too focused on the past and what's happened in the past, what the company has been, what it's done, its historical numbers. Whereas growth investors, by their nature, are focusing on the future. Where is the company going? Not necessarily where it has been, but where it's going. So I think if you can merge that, obviously, with value investing, you have to still do your due diligence, value in the company, all of that. But I think taking a more strategic look going forward and not always focusing on their historic information, but really looking at the future. I think if you can build that in as a value investor into your investment thesis, I think it's something that it'll only benefit investors.
Yeah, to your point, I'm now thinking, have I ever heard a dividend growth investor talking about total addressable market? And honestly, I can't remember if I heard anyone ever saying that in their analysis. And I think this is typical what growth investors look at, right?
Yeah, exactly.
Good one. And so to maybe then shift a little bit to the last two questions that we have prepared. Do you own any European companies?
I don't at the moment, and that's probably due to my change in strategy. I think most of the European companies are probably dividend payers. Like, there's not as many. There is still growth stocks and high tech companies, but a lot of them just end up going to America and listing on the NASDAQ or whatever, because that's where tech kind of congregates. But two stocks that I did look at before I changed my strategy, and I think you guys are fans of these, would be Unilever. When I was about to kind of branch out my dividend growth portion of my portfolio, I was really strongly looking at Unilever. I thought they were really fairly valued. And another one is Nestle. So this is an interesting one. Like when you think about Nestle, you're thinking of, I suppose, chocolate and stuff like that, and confectionaries and snacks. But I was actually looking at this one from a trend that I was looking at, and it's the pet boom. And I'm not sure if you're aware, but Nestle produce a lot of brands that do pet food. And I thought it was really interesting, like, because this is just a trend that I had been looking at over the last while, the boom in pets. And it's kind of come from a mixture of COVID making people, enable them to work from home, and then people moving out from the cities and into the countryside. So lots and lots of people are having pets now that didn't previously, because they can work at home and they're in areas that can facilitate pets. And I was just looking at Nestle are actually have a lot of brands that pet food. So I thought that was quite interesting. Now, I didn't end up investing, but it was something that I was looking at.
Yeah, and I think they did quite well with their pet food business in the last reports. It's
Mm.
interesting because there was a time where I grew up, at least, we would give our dogs just the leftovers of the day. Nowadays, it needs to be all like in a gold can. But have you also looked at Adyen as an example? Because Adyen is a payment processing company, right?
Yeah, no, I have. I actually released an investment thesis on Square today on my newsletter, and I was looking at those because they're a competitor to Square. Yeah, like it's a very interesting company. It reminds me a lot of Stripe, which is the Irish company. founded by the two Collison brothers. Yeah, shout out to those. They're a really interesting company, and that they'd definitely be something that would fit with my investing strategy. It fits clearly into a trend that I am invested in, which is the war on cash. So that's definitely one that it's on my radar. Now I can't say I've looked at it in detail, but that's a European stock that I think a European growth stock. It's flying the flag at the moment.
Are these trends long-term trends, or would you focus on short-term trends? Say like Ryanair, for example. I know they've doubled in price over the last year. Obviously, airlines and travel industry was hit really, really hard, but it was only a matter of time before they came back up. Would you focus on short-term trends as well?
No, I wouldn't really, to be honest. I think in that scenario, like it was probably pretty obvious that the airlines were being sold off too much. Probably the energy companies as well. For me, I wouldn't really classify that as a trend. I think that's just kind of an event, more so than a trend. When I'm kind of looking at trends, you're really looking at least 5 years, and possibly longer. So you kind of just have to kind of draw the line that I wouldn't probably classify that as a trend, more so than just an event.
Cool. And maybe then for the last question is kind of how long will it take you? Like, do you have a retirement date in mind, or how long will it take you? And what are you going to do when you become rich from your growth investing?
So I suppose the goal is to be within 15 to 20 years to be financially free is the goal. And I suppose the round figure that you'd have in your head would be the $500,000 figure, I suppose. It's kind of, that's generally kind of perceived as a figure that if you were to start drawing that down, then kind of like in a 4% rule or something like that. But I probably wouldn't retire fully in 15 years. I'd probably still work part-time or do something. So it's probably not something I've thought about too much, really. It's more so just about, for me, investing for the future, accumulating wealth, accumulating knowledge as well. And then when I get to that stage, having the option to say, right, I don't really want to work these long hours anymore. I want to take a job that's a bit more relaxed. It might pay less, but it means that I can clock out at 5 o'clock with no worries and stuff like that. So it's really just about giving myself options in 10 or 15 years.
Does property investing tempt you? I know in Ireland it's quite popular, and there are ways to make property investment more tax efficient than our two styles. Would that tempt you in 10 or 15 years time?
So at the moment, I'm still a renter, so I don't even have, I'm not on the property market at all. I'd eventually like to buy my own house. But in terms of investment property, yes and no. I think it'd just take too many of my resources, and I think you're just going to be so concentrated in it that it's probably not something that I'm going to go down. I'm not really interested in it. I know the problem though with it is that in Ireland everything is geared towards it, so you're nearly being pushed that way into getting into property. Get on the property ladder as fast and as early as you can, and then once you're on the ladder, it doesn't matter because there's people coming in under you and you're just getting pushed up the ladder. So it's not something that I plan to get into, but I don't think so. But it's not something that I've said yes I want to do it or no I don't. But at this point, I'm more than happy to have my investment portfolio instead, and just monitor and manage that rather than having some tenants.
Yeah, cool. Hey, it was nice chatting to you about your investment strategy, and it's good for mainly the Irish investors, because I get lots of questions from Irish people about tax and why I choose dividend investing, and it's good for them to hear your point of view. The tax rate is important, but it's also important to know that our tax situation is completely different.
Yeah,
I completely understand why you do what you do, but I prefer steady income, and I'm going to retire in 9 years. So we move on to some listeners' questions.
Yeah,
great.
Let's do that.
Okay.
We've got quite some of those, so let's see how quick we get through them. And maybe the first question is from Phil, and he asks us, please rank the following by importance to you. So The first element is dividend growth. The second one is cash flow growth. The third one is earnings growth. And the fourth one is revenue growth.
Okay.
Who would like to take it?
I'll go first. Cash flow, number 1. Number 2, probably revenue, then dividend, then earnings.
Yes, for me, exactly the same.
Mine would be slightly differently. I'd be going with revenue growth first, cash flow second, earnings third, and dividend fourth.
Oh, cut the show. You can't say dividends last.
Well, we'll cut that out from the show. Don't worry, EMF. Okay, then Dividend Wave has a special question for you, actually. And he understands, and that's also what I know, that your largest position is, I believe it's NIO, right?
Yeah.
Which has quite a high market cap. When effectively is asking the question, when would you reduce your exposure or sell? Have you considered that already at these kinds of levels?
Yeah. So this is an interesting one. I suppose if anybody that does follow me on Twitter will know that NIO is my largest position, with quite a while. But if you actually look at how that's happened, it's actually quite interesting. So on a market value basis, NIO is the largest position at the moment. I just checked it before the show. It's making up 9.5% of my portfolio. But if you were to look at a cost basis, so the actual individual amount of money that I've invested into portfolio, it's only the 8th largest, and it only makes up about 5% of the portfolio on a cash invested basis. So I think that's actually just something important to just kind of differentiate there, that it's really because of the growth, the share price, that it's turned into my largest investment.
Yeah, now you have the issue. If you sell it, are you willing to pay the tax bill on it?
Exactly.
Yeah.
That's the thing. Yeah, exactly. But just going back to Dividend Wave's question, of course I've looked at it, and would I have reasons to sell? Yes, I would. I think you always have to have reasons or know why you would sell a stock. I'm pretty lucky in that my cost basis is very low at the moment on this, so it has retracted quite a bit. And I think it still is expensive, especially for value investors. If you're looking at NIO, you're probably scratching your head. But for me, I'm looking at the future with NIO and the growth. But I think one of the big indicators coming up is its European expansion. And it had an event recently, just showing about its launch in Norway. So its headquarters are going to be in Norway, and they're going to start selling cars there from September. So I think this is an important event. So like if this goes horribly for NIO, that would be a big signal to me that this isn't going to work outside of China. So that would be something that I'm going to be watching over the next couple of months and years, I suppose, just to see how the European expansion works, because part of my bull case is that NIO is not just a Chinese dominant market. It's going to be Europe, it's going to be America eventually.
Going to be global.
It's going to be global, yeah.
I hope so, because my son loves NIO and he has some in his own portfolio, and I now have some because I was assigned some shares through a put strategy. So I'm selling covered calls, which I hope get hit this week or next week. But for the moment, I wanted to go to the moon just like you do. Okay, so Taurus Invest, he's asked me what my favorite growth stock is, and what's Wolf of Hardcourt Street favorite dividend stock. I'll go first. I don't really know too many growth stocks, but I have been assigned both Twitter and NIO. So I'm going to pick Twitter because they're more expensive and they take up more of my portfolio in that case. That's the only reason I have for them. Your turn.
Yeah. My favorite dividend stock at the moment is IIPR, so Innovative Industrial Properties, which is a REIT, and it focuses on buying properties and leasing them to do with medicinal cannabis. So again, this kind of stock just was a trend of mine. The trend was the legalization of cannabis, which was a clear trend to me in the US. So it's based on that trend. It pays a nice dividend. It's been increasing it pretty significantly over the last couple of years. And I think the opportunity for capital growth is strong there as well. So that's one of my favorite dividend stocks at the moment.
And that leads nicely on to the next question, because Sheep Stocks has asked me, will the Wolf finally convince you to start a position in IIPR? And I've promised you this, I don't know, 100 times, that I will sit down and look into this company, and I still have not done it. So maybe you'll just have to write it out for me. I might read it, but I'm making no more promises. So Odysseus has asked us kind of a funny question. He has a graph with this, and we'll try and show this on our Twitter and on YouTube. But he asked us, using the Dunning-Kruger effect, where do you guys see yourself as an investor nowadays? And for those that can't see the visual, it's a graph there, and it has a confidence level and a competence level, and it rates you as peak of Mount Stupid, valley of despair, slope of enlightenment, and then plateau of sustainability. So, Wolf of Hardcourt Street, where do you see yourself as an investor?
Yeah, well, I'd like to think I'm not in the valley, in the valley of despair, but I'm probably just heading on the slope. I definitely think I'm relatively new to this. Only really a year in terms of actually investing. I think I'm still learning, still always trying to learn every day. So I think I'm just out of the valley and probably just heading up the slope.
European DJI?
Yeah, I think I'm already a little bit further on the slope. I would even say already going towards plateau of sustainability, but they have the term guru there. I don't think I'm a guru, so that's the wrong wording. But I think I reduced significantly the risk of stupidity on myself by having really analyzed my past mistakes, like General Electric, Value Aid, Tupperware, all these kinds of stupid investment decisions. So I think I reduced that risk a lot. And lately I've been quite doing well with the investments that I'm having. So I have 2 brokerage accounts, and in the first one I have a lot of old investments. It's behaving poorly. On the gyro, it's going much better, which is the ones that I started to really do more due diligence and analyze and such, and I can see clear performance difference in performance figures there. But maybe me thinking that I'm there is maybe also then a sign that I'm just at the peak of Mount Stupid. Yeah, who knows?
Looking at the chart, you have peak of Mount Stupid at initial confidence level.
Yeah.
And look, I see myself as a beginner investor. I'm doing this nearly 4 years now, but I've been doing it in a bull market. And look, everybody's correct in the bull market because stocks only go up. I think our strategy, you'll only see the weaknesses in either big events or when a crash happens, and you'll see the real strength of companies. So it's a little bit early for me to say that I'm on the slope of enlightenment and that I'm confident in what I do. But I certainly am a better investor now than I was this time last year, and so on. So it's just about keep growing and keep going forward. So a good question and quite funny with the graph. So thanks a million for that, Odysseus. Okay, Dividend and Check has a question for you, Wolf, and he says, in case I heard correctly, Wolf of Hardcourt Street changed his strategy from dividend to growth. Can he compare his performance at the time between the different strategies?
Yeah, so with this one, like I've only actually sold 3 stocks so far. So it's actually quite difficult to compare the performance because it wasn't a complete total portfolio revamp. I only really sold 3 of those stocks. So it has been quite difficult to probably do that. Now, you could argue recently with the tech sell-off, and I'm more weighted to growth, that in the short term I probably have you could argue underperformed based on selling those stocks, but I am a long-term investor with a long-term horizon, so the short-term performance isn't really what I try to focus on.
Cool. We'll move on to Tommy's question, and this is for you, European DJI. He's asked you, if a company is plus 20, 30, 40%. Do you use stop losses to secure a certain percentage? I don't know if stop loss is the right word there. And if so, how much percentage do you like to secure? So I imagine he's talking about maybe a market order or an order if a company grows too fast.
Yeah, it's called a stop loss.
Is it?
So yeah, what you can do is you
Stop
can
loss.
say that it automatically sells if the stock drops 10%. These are these kinds of strategies that you can use as some brokers.
I just see the plus sign. I assumed he meant it grows 20, 30, 40%.
Yeah, so what you can do is like you don't need to sell while it's still growing, but then once it dips 10%, it automatically triggers a sale.
Okay, I get
So no, I'm not using this kind of stuff. This was when I was at Mount Stupid, like 10 years ago. I used that, and you have always these daily actions. Sometimes that a stock dips, and it was like bottom fishing, but then for me bottom selling. So no, I'm not doing that because I invest in businesses and I believe in those businesses. And if there's, let's say, a black swan event which is out of the blast zone of the companies that I own, I wouldn't sell because I believe in the business. So if nothing fundamentals change, if my thesis is still there, and I'm talking here about my 10-year thesis, not like a miss in a quarter. So for me, stop losses and such make totally no sense. I rather sell put options to buy more. So that's what I actually more do, and use the put options kind of as additional dividend income.
Yeah.
So I did this really 10 years ago. I was doing this because I was afraid to lose money at the time.
Yeah. But your goal now, you're like you invest for income now, so it's not.
Yeah. Price is not so relevant from that point of view.
You're not planning on selling these companies, so
No, not at all.
It doesn't matter. In fact, sometimes we rather, and I said this recently, I'd rather the prices come down so we can load up a little bit more.
Yeah.
But yeah, no, I'd agree with you. I wouldn't bother. I wouldn't bother selling. Sell the dip. That's the phrase there. Is it?
Sell the dip. Yeah.
Yeah, and I'd be the exact same. I don't believe in stop losses.
Cool. So Tiago Diaz has asked us, what is your highest confidence stock pick? For me, it's Microsoft. Quite simple. Everything they do is turning to gold at the moment. Just a quality company.
Same here, Microsoft.
Yeah, and to be honest, if I had to only hold one stock, I'd probably go with Microsoft.
Quite boring. We all copied each other.
Yeah, exactly.
I'm going to change mine. I'm going to pick ABV. Okay, and the last question comes from Chris. And I suppose this is for you. Wolfie says, as one of the few people that I've seen that talk about owning Johnson & Johnson and something like SE, how do you maintain that mental agility to go between these two different types of companies with conviction?
Yeah, I think that's a good question, and it's probably to do with my overall strategy. I've got growth stocks and I've got value stocks. So I think I might have mentioned this earlier. I don't like to just pigeonhole myself and say that I only invest in growth stocks, or I only invest in value stocks. I do like to have a mix, and I think arguably stocks that you might refer as to defensive, like a Johnson & Johnson, or stocks like that. Like I think they're just as important in my portfolio anyway, because you could compare it to like a football team, I suppose. And if you've got 11 strikers on the pitch, if you've got 11 C limiteds or 11 neos, that's great when the goals are going in. But on the bad days, you're going to be exposed at the back. So I think you do need some stocks that are less volatile and steady, like a Johnson & Johnson, an ABBV, I've got Brookfield Renewable, a Microsoft. These sort of stocks that are kind of rock solid at the back, as I like to call them.
Awesome. I forgot you were talking about stocks. I thought you were talking about Liverpool last year versus Liverpool this year. No, that's a great question, and it's as someone that has pigeoned himself in it, I could see that it could be hard to go between the two, but no, that's a good answer. So that's it. All the questions. Thanks very much to everyone. Wolf, it's been a pleasure having you on. It's great to have another Irish accent out there. more of our European listeners might be scratching their heads trying to use the subtitles. But thanks a million for coming on. It's been a pleasure. It's maybe helped some of the Irish listeners that follow me and follow us understand other strategies and to realize dividend growth investing can be used as part of a strategy in conjunction with other strategies as well. So great insights, and thank you for coming on the show.
No, thanks a lot, guys. Like it's been great, and ultimately we're all investors. We're passionate about the same thing. We might do it in slightly different ways, but everyone has their own strategy, their own style. But I think we're all ultimately chasing the same thing.
Well, I really love your work. I like your Substack. We've also been chatting a bit on the background, so we'll put the link to your blog, your Substack blog, in the description of the podcast, plus a link to Twitter. Recommendation is to follow Wolf of Hardcourt Street, and I just say to everyone, have a great weekend, have a good week, and see you next week around this time again.
See you all next week.